Okay, I think we've got market open coming up on your screens right about now. What do we have? First rates, 25,690 or so on the Nifty, which is down about 1/3%. That's 80 points. You've got the Nifty Bank, which is almost flattish, red, green, but basically unchanged, undecided. The Sensex is down about 0.2%. The mid-cap index is down about 1/3%. The small-cap index will come up as well with what it is doing, about 0.5% lower on the small-cap index. 800 up and about 600 lower. That's the advanced decline ratio as things stand right now. And that's the screen, folks, with what's happening. 45 lower on the Nifty, 25,725 at this stage.
All right.
Well, I don't think we have the heat map coming up, but maybe we'll have more individual names. Let's throw it across to Mangalam on the big wall, Mangalam.
Yeah, let's go across. You know, it's 60-point downtick is what we're seeing. But on the Nifty gainers or the Nifty losers, the top mover today is actually Trent. Why do I say that? Because, you know, the stock was up 5% ahead of numbers yesterday. The street was anticipating a bit of a beat that would come by. But turns out maybe the street does not like, or maybe a large part of the margin surprise has been priced in, which is why the stock is lower. The advanced decline, which opened in firm favor of advances, has now come closer as well. So we do have enough number of stocks, an equal number of stocks advancing and declining. Let's look at some of the other result reactions. Medanta and Metropolis, both of them had reported a decent set of numbers. So let's see whether the street likes it. Perhaps not. On a decent set of numbers, the stock has seen a bit of a sell-off for Medanta. Metropolis as well should come up for you. My sense is in the pre-open it settled in the positive and now has opened about 4% higher. Force Motors, that's the stock of this morning, up nearly 4%, a very strong performance coming in. All of 2025, the stock has seen a big move, and this continues. CCL Products is the other one. Higher coffee prices has improved their realization, so 59% profit growth out there, 5% higher on that stock as well. Two other stocks, JSW Cement, you know, it turned around the bottom line. They reported a big profit versus a loss. Let's see whether, you know, the street acknowledges that. Yes, 4% higher on that one. And Avalon Tech, the stock has been in favor of, you know, the US-India trade deal that happened, etc. The numbers are good as well. But after the up move that we've seen some profit taking out there. Cummins India, there is a bull versus bear case out there. Currently, the bears are winning with a cut of almost 2.5% on the stock. All eyes will be then on, you know, what the management says in the con call. NHPC is the other one. Seasonally weak quarter for them. Welspun Enterprises, also a weak performance coming in from them. And Keystone as well as Jubilant and Grevia. Both these stocks are sharply lower. One pack that stands out on the way down today is the metals pack. The overnight volatility in commodities. So if you pull up something like a Vedanta, Hind Zinc or Nalco, the metals index down about 2%. The Nifty just about 37 points lower. Not a big worry so far, but among the sectors that are not doing too well has to be IT and metals. They're the sectors which are a bit on the downside. The Nifty Bank holding up after yesterday's outperformance.
Well, IT is actually now stabilizing. So the Nifty IT index is flattish. TCS, Infosys, HCL Tech, Wipro, all in the green now. And this is after the big fall that we had yesterday and Cognizant's calendar year 26 guidance positively surprising the street. Hexaware, though, is taking a big knock, posts a disappointing set of numbers, decline in revenue, margin miss. Timken India is another one. Hindustan Aeronautics continues with the fall from yesterday. And on the way up, some more earnings reaction. JSW Cement stands out, and Imami continues with the gain from yesterday. So that's added on another 3%.
Well, absolutely. Lots of single stock action right here and there, and there's more to focus on as we go along. We'll do that over the next 10-15 minutes. Devina Mehra is now with us, founder, chairperson, and MD at First Global. Devina, good morning. It was always a pleasure. And, you know, we are, it's like being in the trenches pretty much every day if you're trading. Waking up to new stuff, and then, you know, start is something, close is something, and then too much, right? I mean, the last 13, 14 months has been like 3 years compressed. This, and I'm sure you're feeling it too, we are certainly. Now, this IT thing, right, and we had Girish Pai, who's a veteran IT analyst, we had Sandeep, we had other people yesterday, lots of opinion, range of opinion. We heard from Cognizant management about the disruption that they're facing. What is your sense, Devina? How to think about this particular question from an actionable standpoint for viewers who are watching? His point, Sandeep's point was it'll continue to, P multiples will continue to deteriorate. And I think it's something similar, the point which Girish made as well. Your thoughts?
Yeah, I mean, I'm still working through the implications. I can't say I have the final answers yet. And from my discussion with some of the IT, this was before, I mean, this latest news, IT majors as well as NASSCOM, etc., was that they, in terms of employment, they expecting more like a J thing that employment might not increase, might even decline in IT for a while, but then, more opportunities will come and it will sort of go up. And if just going back 20 odd years, there's been the kind of the death knell of IT services has been sounded many times from the time that it was all Y2K work and it will go away. Now that cloud has come, IT services will not be needed as much, or software as a service has come, it won't be needed as much. There'll be digitization. But all those things they have been able to navigate. I mean, I still don't think that employment-wise, they will be the driver for the Indian economy as an employer, as they have been in for the last 2.5 decades. So that part definitely will change. But in terms of businesses, whether they'd be able to pivot, I would still think that they would, because AI, it's not as if that AI has come out of the blue for them. They've been working towards gearing up for that for quite a while. So if you talk to the companies and the people heading the AI practices, they've been gearing up towards that. And I do not think, this is the time to be kind of panic selling out of IT. Yeah. Everything kind of moves in cycles. So you had banking last year after 4 out of 5 years of underperformance doing better. IT, let us also wait for what each of the companies say about. I'm sure they will also.
Devina, and
I'm not like in a panic seller of IT.
Yeah, Shireen spoke with Rishit Premji of Wipro, Salil Parekh of Infosys. We had TCS management and a few more. All of them recently in Davos. I mean, just a few weeks back, and they all kind of pushed back hard to what you're saying, that it's not new for them. They'll use it. And they'll be essentially very much required to integrate all these technologies with enterprise workflow, which is where essentially the problem happens.
Because see, enterprises are not going to hand over something
Correct.
to AI without an intermediary.
Yeah.
Even after, I mean, let alone at that stage, just look at even now how the IT services business works. It's not as if most of the time the enterprise directly only deals with the actual company doing the IT services, which is usually the Indian company. Normally, you have like a couple of layers above that with consultancies and the more high-profile IT companies also in the loop on that. So, I mean, enterprises always like to ring-fence all their risks, so they are not going to, kind of hand over the keys. But as I said, the delivery model itself might change.
Yeah. Palantir came out with numbers about 2 days back, but yesterday was the earnings call, and they're saying their AI platform is replacing third-party software and compressing large ERP and SAP implementation timelines from years to weeks. So Devina, while there's no doubt there's going to be, no AI platform is going to replace the intermediary, lack of a, simpler word, but it could compress the revenues. There could be deflationary pressure. Instead of requiring 5 engineers, maybe you require 2 engineers going forward. So that does put the pressure on IT. So I get you don't want to panic sell right now, but would you look to bottom fish right now? What is the advice that you're giving to your clients? And what is the position of IT in your own portfolio?
So we continue to be about market weight on IT, probably marginally more than market weight, or about market weight is when I last looked at it was about that much. And as I said, there's been a long period of underperformance, so you might also want to look at that. But I'm not saying that this should be either panic selling or panic buying in IT right now.
So
the only point, Rima, is that this point about AI, right? And this is a thing to think about. Can they use AI? Like, using AI is, in a way, cutting your own feet? That's the question, because the model has been, billable seats and a number of hours spent, etc. But if effort is reducing 25-30%, that model, some new model needs to take place, right? But the business models are changing everywhere.
That's what I said. They have pivoted in the past also in terms of models. So that part, I'm sure they will be able to. It's not as if that they will say that we continue this. As I started by saying that the employment, IT as an employment driver for the Indian economy definitely is going to slow down. And that is the part which is a more macro thing. If you look at last 25 years, IT-enabled services, and uh, because all those people were employed there, their whatever drivers, house staff, security, food delivery, it has been a driver of a lot of things on the macro front. That's the part to really worry about.
So what drives the economy from here on, now that IT has done it in the past, and how do you play it via the listed space, which has acceptable valuations, if not attractive?
Actually, if you look at the industry-wise Ps, they are not at extreme ends. I mean, there's no point looking at a macro index level PE, because the composition of, let us say, the Nifty or the Sensex, you go back 25, 30 years, has changed so much. There was at one point, there were no banks in all these indexes, and now that's the banking and lending is the highest weight. Similarly, I mean, at one point, they used to be dominated by PSUs. In between, I think, 15 years, all of us forgot that there were PSUs were listed and could be invested in. But that apart, if you look at, as I said, industry by industry, the Ps, even if you look at a crude measure like that, are not at extreme ends. Many times they are below even the average for the last 1 or 2 decades. So, I mean, you can't say their valuations are particularly nasty right now. And even in terms of if you plot the market return trend line, we are not above the trend line. So all those things are indicators that you have there could be there doesn't appear to be any risk of a big crash. And whenever that is not the case, the thing is always to remain invested to the extent of your equity allocation. I always say don't have 100% in equity, because equity is not predictable returns for 1, 2, 3 years. So don't have anything that you will need to withdraw in the next 5 to 7 years in equity. But other than that, remain invested in equity. Maybe not in the same old stocks that you bought in, let's say, 2024. That also is the other part of the equation. But remain invested, and it is always, of course, bottom up. Out of that, right now, for the last 2 years, we've been overweight auto components and later bit of auto also. So that still remains. Pharma and healthcare, our overweight still remains. Last 1 year, there were some FMCG picks that came in, some chemical picks that came in. Capital goods, of course, off and on. Last 4 years, we've been there, though not overweight anymore. Banking also we added last year. Still not anywhere close to overweight, but more than what we generally hold. So there are plenty of opportunities. I mean, they're like, depending on, what your worldview is. But, for the demographic dividend of India and their finding employment, the young working population that we add every year, the IT part can be a blow. Further blow. I mean, as it is, we are not doing particularly well on this front.
Devina, but generally, are you surprised that after the conclusion of the India-US trade deal, or the framework of it, we only had a one-day rally, and after that, it fizzled out. We've had 2 sideways days. I mean, did that surprise you, since that was seen as a big sentiment, driver, and there was a change in that?
Sorry, which deal?
I'm saying the India-US trade deal. After that, we had only a one-day rally. So did that surprise you?
No, it didn't, because if you look at the listed space, the exposure to US exports is rather limited. That's one. The other thing is there's no deal yet. I mean, the commerce minister also said that not only has the deal not been signed, the exact contours have not been worked out. So exactly, what will be the products covered, what will happen to each of them, none of that has even been finalized, let alone signed. And if you look at the listed space, we don't have a big weight for the traditional exports of textile, jewelry, etc. Of course, engineering, auto components, etc. Now we have some significant exports. Pharma is another one. Which was like kind of not part of general tariffs. So it is not very surprising. But it also showed you that even a one-day move can be very significant, which brings me back to that whole thing of remaining invested, because it is when there are a lot of talk of risks and bad sentiment is when the market surprises you. So since the beginning of January, I've been saying that while I never give index projections, but the very fact that nowadays when you listen to anything, whether on television or on digital platforms, everybody, instead of talking the usual India growth story, is enumerating all the risks.
Well, Devina, you've been fairly candid in your perspective and advice in the past as well on a whole host of sectors, stocks issues, including that of the overvaluation of IPO. But you said one needs to be invested in equity to the extent the asset allocation allows. What's your sense on commodities right now, silver and gold? After the big rally that we've seen, the big crash, now there is volatility. Do you have a view here?
So, I mean, I've been saying that you should have allocation in silver and gold, but normally in both our India and global allocations, we have single-digit allocation, which, a few weeks ago, everybody was kind of jeering at me saying that you don't know, the world has changed and there's a one-way rally in gold or silver. And then you saw the volatility, because that's what history shows. If you go back 50 years, you will see, if you plot the US dollar chart of gold and even silver, you will find huge volatility. Actually, calculated volatility of gold is higher than the volatility of equities. That is the data which nobody wanted to look at. And also, there was this thing that gold has not seen this kind of rally since 1979. Gold made a high in 1980. That high was not crossed for 27 long years, till 2007. 19 years after that high, it was still down 60%. And this was not an aberration. After that, 2007, it made another high, and then it crashed another 40%. So that's the nature of the beast. In rupee terms, gold looks good because it's essentially a rupee depreciation chart. So, our grandmothers were not wrong to do an SIP in gold every Dhanteras, because at that time, there was no other alternative hard currency assets that you could buy. You could not invest in overseas markets. But now all your hard currency exposure doesn't need to be via gold. So please diversify your investments outside India. But gold is not the only way. As I said, have an allocation, but it should not be like 35-40% of your allocation.
Devina, always a pleasure speaking with you. Thank you very much for joining us this morning on CNBC-TV18. Moving on now, we've got a management waiting by. Hexaware is under pressure. Stock is down 6.5% after reporting a disappointing Q4. R. Sri Krishna, CEO and Executive Director of Hexaware, is now joining in. Thank you very much, Keech, for joining us. Explain to us first what led to the decline in revenue in Q4. And two, you're saying that the company is going through an unusually weak period, seasonality aside. Explain to us and what it means for Q1.
Sure. So, Rima, good to speak to you. Our Q4 was not very much off what we expected. It is always a seasonally weak quarter for us. If you look at number of years, we have declines, sequential declines in Q4. There were some additional kind of one-offs that there was one large client that had a reduction in quarter. There were higher furloughs than expected in quarter. But in aggregate, still, it is not very much different from what we expected. Now, your second comment, we said we are going through an unusually difficult Q1 and Q4. So Q4, I already spoke about. Some of what happened in Q4 is going to carry forward into Q1. But after that period, we actually expect that we will grow nicely and accelerate growth through every quarter in calendar 26.
So Q1 also, revenue sees a decline?
Well, it'll be, historically, again, if you look at Q1, it is always a soft quarter for us. It is flattish.
Okay, so Q1 could be flattish historically, and this time should be no different. But just coming back to the one-offs which impacted your revenue in Q4, could you put a number to it?
So there were two, and actually I'll say between the two, it impacted 60 to 70 pips of growth.
One. Okay. Now, Keech, the big worry is these, agentic AI developments from many of these big tech companies is going to put pressure not just on the software company, the package implementation companies, but even the IT outsourcing companies which help with the implementation of this packaged software, the application development maintenance, which is a fair amount of the IT services revenues, ADM, as we call it. and that will cause revenue deflation. Explain to us how you see the impact and what exactly is happening.
So first is we agree that packet software can get replaced by agentic workflows and by cloud native software. We agree. However, we see it actually as a very large opportunity for us for two reasons. One, we don't actually have too much legacy business in packet software implementation. So whatever headwinds are there is very limited for us on that front. More importantly, 3 weeks ago, we were the first in the world to launch a service called Zero License. Zero License, essentially, as the name suggests, is a proposition to help our customers get off any licensed software, which includes COTS, packet software, and SaaS. So we agree with the thesis that they can be replaced, but we actually think it's a very large opportunity for Hexaware.
You know,
we were the first off in the world to
do that.
Launch a service specific to that.
Yeah, no, absolutely. You know, the point, Sri Krishna, hi, morning, Prashant here, is that the argument, I mean, this is, of course, markets are jumpy and they kind of shoot first and ask questions later. So that's what, you know, markets do. Now, using AI, is it fundamentally, in a way, deflationary? The question is about pricing at the end of the day, right? Because you're replacing something. I mean, you were earning, I'm not you, I'm saying the industry was earning, say, $100. Effort goes down by 25, 30% in some cases. So that 100 is not 100, right? It's a question mark, whether it'll be whatever it is. Unless the volume of work explodes so much, and that may happen, but that's a long drawn story. Is that thesis, is that the right way to think about it? I mean, that 100 may be 90, 80, 70, 50, we don't know. And that level will... So it's basically, what's the rate of growth from here we're looking at? That's the real question.
So both of what he said are correct. Okay. First is that for any piece of work that goes through transformation, often happens at the point of rebid, there'll be deflation. We actually said in our earnings call earlier today that traditional services, there will be a deflationary impact, and we've accounted for that in the numbers we're talking about. On the other hand, there will be new services and new volumes that more than make up for it. Let me give you two examples of services we've launched that have new volumes. First is, a year ago, we launched a service called Legacy Modernization. This is to help modernize code written 70 years ago that nobody in the world knows anything about. Now, this is a problem that could not be solved without AI, and now customers are putting big budgets to solve for legacy. That's example one. Example two is the one that we just spoke about, SaaS. Think of that market. It's in hundreds of billions of dollars. That's all net new volume. You know, who can address that effectively? Because the code is not going to write itself. It's not just about the code. You really have to understand the business processes that are encoded. How do you understand those business processes? Then the last step is really generating the code, which is easier. But in aggregate, it is still a lot of work, and a lot of spend, which went into license fee, that will get translated to custom software development and agentic development.
What's the extent of deflation seen in the legacy traditional business?
See, whenever a customer is going through a process of saying, okay, now let's do it in a new way, and often it's at the point of renewal, it could be 20 to 40%, depending on the type of work. But not all of this is happening on day one or at a given point of time. So I'll say in aggregate, because these tend to get staggered over a fairly long period of time, in a given year, you know, we think it'll be like 2%, 3% deflation, and we've accounted for that in how we think about our numbers.
And will this 2 to 3% annual deflationary impact that you're seeing today accelerate? Can that become 5 to 6% in the coming year?
I think that the new services and the new kind of work, it's not going to go to everyone, but people are focused on it, are agile, nimble, have innovation to address the new areas. That will far exceed the deflation. So in aggregate, we actually expect there'll be net positive growth because of AI.
You have guided for this calendar year growth to be better than last year, which is 7.5%. But you're a company which used to see double-digit growth, mid-teens, high teens kind of a revenue growth. Given this deflationary impact that we are seeing, do you think getting back to double-digit is going to be hard for the next, say, 3 years?
So we said, while this is the guidance that we've called out essentially as a bottom, our core thesis of growing in low teens and several accelerators to get us to mid to high teens remains completely intact. If you look at our history, every year that we've grown under 10%, the next 2 years have been outstanding growth. So I don't expect a challenge in getting to double-digit growth in the future at all.
Well, thank you very much for joining us. We wish you all the best of luck. And this is a story we want to follow and hope you'll come back as we do that here on CNBC-TV18. Thank you very much for joining us. Hexaware stock is down about 8% as we look at it right now. Markets are taking a bit of a knock as well. And it's maybe time to just look at the advanced decline ratio as well, right? I think 100 points lower on the Nifty, but the broader market, of course, did well. Small cap index ended about 1% higher. There is the broader market, which perhaps should be in focus. Yeah, it's down. 2:1 in favor of the number of stocks which are lower. I was talking about how we got the top Indian IT companies out of Davos just a few weeks back. So this is the latest and most current view. And I just want to play some of that out. Salil Parekh, CEO and MD Infosys.
How much of this new AI opportunity is likely to cannibalize on the existing maintenance revenue?
So there we've built some estimates which show there is some compression of revenue in different services because many of the AI agents improve productivity. But equally, we see a larger pool which is growth opportunities. And we will showcase that to show that net we see much more growth than compression.
I also want to understand from you how your contracts and your billing is being reworked in light of the fact that you're now doing AI work as part of it. So there's agents and so on and so forth. How are contracts, is pricing being changed on account of the AI influence and the AI adoption?
It's very early, but my sense is it will change. So first, as you know very well, a lot of things were moving to outcome-based. So agents will support that. And as we go through time, my sense is there'll be a mix because we work on what we call pods. Pods have engineers in them. We will also have some part of it with software agents. So the pricing will evolve, but today not a lot has changed, much more outcome-based.
Okay, so what could that potentially mean as you look at repricing in this era that you intend to transition into?
Not very clear yet, meaning there is a lot more value that these agents and the joint work will deliver. But as always, at least what we've seen in the past, part of that value shared with the client and part then comes to Infosys.
So in terms of margin impact is what I'm trying to understand what it would mean.
So the margin, first, we've had a very strong margin program over the last year and a half. So we are very clear that our margin will remain at the guidance we are at right now. We don't see anything which will become negative on that.
What should the next chapter in our AI journey as a country look like?
See, if you look at from what the traditional lens, most of the Indian companies are good at, the traditional services companies. I agree with what the minister said, he talked about the 5-layer approach and what in TCS we call it the infrastructure to intelligence. There are multiple layers from infrastructure. There is a model layer, there is application or the agent building layer and the experience layer on top. And while many of the IT companies in India have not built their own models, but we should not lose fact that the value actually comes in understanding the business context of our customers, ensuring the data for the customer data works for them. And I think that's our course capability. And most of us are focused on that, and you'd see us delivering value from that.
So there's going to be no change. You're not going to go the LLM way.
I'm not saying there won't be change, but don't underestimate what we are doing. We somehow seem to underestimate or brush aside saying, you guys are not doing models, so your legacy. No. What we actually do is making a real for our customers. Model is one component, but making the models work and work for the customers is the most important. That's where the value is.
All right, the market continues to extend its sell-off at the low point of the day for the Nifty right now, 150 points lower. 25,630 is where we are right now. Yesterday's low was closer to 25,550, so that's a level that we will be tracking very closely. The reason why we're lower today as against yesterday is there's no support coming in from any of the big weights. The Nifty Bank is down about 1%. We have Reliance as well, which is down about 0.7%. The Nifty Bank down about 1/5%, and a lot of these heavyweights are selling off. The likes of Maruti, M&M, the Auto Pack, and the Metals Pack, all of them out and about down right now as we speak. Take a short break, come back. On the other side, we get chatting with the management of Tata Power to discuss their third quarter earnings. Welcome back. You're watching us here on Corporate Radar. We have with us the management of Tata Power. Reported a muted set of third quarter earnings. The business was impacted due to a base year one-off and Mundra shutdown. Praveer Sinha, who's the MD and CEO of the company, joins us to discuss the company's third quarter numbers. Thanks a lot, Mr. Sinha, for joining in. We'll be discussing the three following points. Key expectations from the Mundra resolution, power demand trends, how they are in January and December, along with Discom privatization, the UP Discom privatization, has then been delayed or not? Let's start with the Mundra shutdown itself. What kind of resolution do you expect and by when? There is some clarity awaited on the PPA with state governments. If you could give us a sense on that first and then speak about demand, how it panned out towards the end of the quarter and the start of Q4.
So starting with Mundra, I think that we are very close to finalizing it with the government of Gujarat. All the 12 issues have been agreed on. There is only one issue, which is supply beyond 2038 till when we have the PPA. We are discussing that, and hopefully in next few weeks we should be able to close it. We also have been in discussion with all the other states, and all the other 4 procurer states have asked that once Gujarat agrees on the framework, the same framework they will also adopt. And we do expect that within this month, we should be able to close with all the other states and start the operation of the plant. It will be very good for everyone in the sense that Mundra continues to be one of the lowest cost producer of power. It will also be fully geared up and ready to supply during the summer months. So I think it's a win-win for everyone, and we should see that the Mundra operation starts within this month.
You said all 12 issues have been resolved, because the last time you joined, you said there was one issue which was pending, the government supplementary PPA. That has been resolved as well, right?
Yes, absolutely right.
So that should, provide some sort of relief to the street as well. And on the UP Discom privatization getting delayed, have you heard further or anything more than what you had told us earlier, where you said that you weren't particularly aware of this? Is there any further development?
So we have been in constant touch with the UP government. It has got delayed. What has happened is that in between, Government of India had set up a group of ministers to examine the financial viability of distribution companies in the country. And they have come up with a set of recommendations which has to be accepted by the government. We are expecting that once that is finalized, we possibly will see not only UP, but many states which will go for public-private partnerships, especially those who have financial stress. And we are quite confident that we'll play a very important role, having seen the turnaround that we have done in Odisha, where both urban and rural consumers have been taken care. So we are very confident that in next 6 to 9 months, we'll get huge number of distribution opportunities in the country.
All right, so all these factors work well for you. Quick, short conversation with you this time around. We'll have a longer one once, there is some clarity on the Mundra, and once that is resolved. But as we speak, just leave us with a guidance for the fourth quarter when it comes to overall, demand, revenue and EBITDA.
I think the overall demand is expected to increase in this quarter. Typically, the third quarter, winter months, we don't have that sort of demand, but we have already seen the demand picking up in January, and with the temperature going up in February, March, we expect a demand of 7 to 8% increase. We are also very confident that all our existing operations, whether it is the cell and module manufacturing, rooftop, our distribution business, transmission business, existing generation operations, they will all do very good. I do expect that Mundra will also start operating by end of the month. And so I think we will end up doing much better than in the third quarter and much better than what we had done last year in the same quarter.
Wonderful. Mr. Sinha, thank you so much for joining in, leaving you with a promise to join us once the Mundra resolution is done. And, there is clarity on that as well. Good luck for the fourth quarter. With that, let's move on to another company that reported a good set of earnings. It is IKS Health. The reason why it was a good performance is because EBITDA margins, they came in at around 34%. Do note, 49% of the company's revenues coming from top 10 clients. Sachin K. Gupta, who's the founder and global CEO of IKS Health, now joins in. There was a 24% revenue growth that happened as well. Thanks a lot for joining in. You've seen 20% plus growth in the last couple of quarters. If you could tell us, what's a sustainable level from here on? And secondly, with the kind of update that has come in from Anthropic, a lot of these services companies are impacted. Do you think AI capabilities in any manner could disrupt a business like yours, or would you benefit from something like it? I think you're on mute. You'll have to unmute yourself.
All right, thank you.
Thanks.
Thank you for having us today, Mangalam, and glad to be with you all. So your first question around growth. Yes, we've had a solid quarter of growth, 24%. We don't give guidance on growth going forward, but Mangalam, I've always said it's a $260 billion TAM, of which about $34 billion has been outsourced, and that outsourced TAM is growing at 12%. And so our simple thinking is, without giving any guidance, if we're growing faster than 12% on a long-term basis, and when I say long-term, I'm thinking 5, 10, 15 years, because that's what I think this unlock is going to look like. And that's sort of the secular growth trend that is going to be witnessed here. On that basis, we continue to believe we have the right to grow faster than that 12% year on year in constant currency terms. And as long as we're doing that, we're capturing market share. This was an outstanding quarter, and we're delighted to have it. But I just want everybody to understand that this is not necessarily linear. And this market is highly volatile. There's a lot of signal to noise still happening as it relates to the hype around AI. And so we still feel comfortable about benchmarking our success on growing faster than 12% in constant currency terms over a very long period of time. As it relates to your question around Anthropic and all of this news, look, I mean, as you know, Mangalam, we are a product company in its very essence, right? We are writing technology to eliminate tasks from the provider's workflow in the US so that they can focus on patient care. We use a tool from Anthropic called Claude that has fundamentally compressed our own engineering cycles. What we were doing using 500 people in 6 months, we're now doing it in 3 months. So we welcome the propagation of these tools like Claude and others that are being rolled out. We are predominantly centered around Claude for all of our code generation activity, which is an Anthropic tool, and we're delighted by its performance. So for us, we look at these kind of code generator type progressions within generative AI as a huge tailwind for our business, and are looking forward to continuing to execute.
Sachin, good to see you after a few quarters. Good morning, Prashant here. And when did this move to Claude happen for you?
Yeah, we've been using it for several months now, Prashant, at least 2 quarters, and we're actually...
So everything is moved to Claude now, is it?
More or less. I mean, there's still some stuff that, Claude is not applicable to. It also requires a certain reorganization of the underlying data and the vectorization of the data sets for it to be largely usable, which is also a process.
So if you're saying earlier what took 500 people takes, you said 100, right, now?
No, half. I said what 500 people did in 6 months, they can perhaps do in 3 months. And that is when we are today not fully optimized.
Correct. So what does that do to revenues? I mean, it's, billable hours, billable people, billable seats, I mean, that kind of thing. What happens? We
don't have any of that, right? We are not in the business of writing code for our customers.
Right.
We produce our own technology. We roll out our technology. We get paid as a percentage of our customers' revenue. So the faster we can write technology, the cheaper we can write technology.
There's no chance that your customers put Claude to work and do it themselves?
I think there is, and there should be, and the more sophisticated customers will use it. But Prashant, I have an anecdote there that is important. What is the IT budget of a JP Morgan? In 2024, it was $14 billion. So when you have an IT budget of $14 billion, you would argue JP Morgan should be able to do everything themselves, and they need no GCCs, no outsourcing. But the reality is 80% of that budget is outsourced. The reality is, just because you have a large spend and a large balance sheet, that doesn't mean that becomes your core competence.
Got it.
Will there be an exceptional system or two that will leverage tools like Claude to eliminate some of their own tasks? Absolutely. And I actually welcome that. And I keep pointing to, look, there's a $260 billion TAM, of which only $34 billion is outsourced. So, there's a lot of white space for everyone.
So let's look at it this way now, because you are using Claude and your productivity has increased. Has that led to the margin expansion? Because 29% in the first 9 months of last year, 34% this year. How much of that is because of operating leverage? How much of that is because of AI? If not because of AI, how much can come because of AI?
So look, we've always guided, since we did the acquisition of Acuity in November 2023, that we will get our margins back to the early to mid-30s. We perhaps got there a couple of quarters sooner than we had ourselves imagined, but I think we're at that place now. And while we will continue to optimize gross margin through the deployment of AI, just keep in mind a metric. We grew 24% year on year, 19% in constant currency, but our headcount grew by 1.5%, which means we are able to do larger and larger number of tasks without using more people. And that is the fundamental answer. And that tells you that we are, of all the signal to noise that is happening in the market, we are a company that is actually using AI-led solutions to eliminate human tasks and continue to break the linearity between revenue growth and people growth. And that's really what I would say. As it relates to margin guidance, I've always said, one, we don't give guidance. Second, we are where we need to be, which is in the early to mid-30s. We will continue to expand our R&D spend, which is currently at 4.7%, gone up from 2% a couple of years ago. We will continue to expand that as our gross margins expand, and we will continue to expand our investments in sales and marketing, which is another key lever of growth.
Got that. Thank you very much for joining us, Sanjay. It's a pleasure, and hope you come back mid-quarter, end of quarter, because I mean there's a lot to talk about with these rapid developments. And you're telling us that you've been on Claude for most of your functions for the last 2 quarters at least. Thank you for being here. IKS is up about 4%, 4.25%. 1675 is where we are at. Well, on to that big exclusive, and this is 2 big global business tycoons, Reliance's Mukesh Ambani and BlackRock's Larry Fink, coming together under one roof to discuss the art of investing for a new era. Larry Fink, of course, saying that this is India's era and Indians must invest as the country grows for between 8-10% for the next decade or so. This is the conversation. And they sat down with Shireen Bhan. Listen to a slice of that.
I would first and state that I don't believe there's an AI bubble.
You don't believe that?
Not at all. I believe the greatest risk we have is if we don't invest and continue to invest, China will win. And I believe the need to rapidly expand the AI opportunities is necessary. That doesn't mean we're not going to have some bankruptcies. We'll have some failures. That's capitalism. You're going to have some big successes and big failures. But the opportunity that companies have in utilizing AI is going to be present in everything we do. I mean, even yesterday you had Anthropic announce a new model, which is going to be threatening for some businesses, but it's going to be an opportunity for other businesses. You mentioned Davos, and you mentioned the word cloud. There's no question AI is among the most topical conversations we're having now because it is disruptive. It's going to be disruptive for some industries, but it's going to also be very advancing. I mean, the future of AI in terms of drug discovery, in terms of humanity, is real. The use of AI for the development of new sources of power or cheaper sources of power, what can that mean in the long run for the global South? Could we have abundance in energy one day? Now that's still pretty far-fetched at this moment, but the opportunities of the acceleration of science is there. Rob Goldstein talked about, having the ability to use AI to learn everything about one subject in minutes now. And so AI is going to allow more discovery, more opportunities, and with that technology, like so many other technologies, it's going to be disruptive for some businesses and some economies.
Mr. Ambani, since we're talking about AI and we're talking about technology, to Larry Fink's point, how do we leverage all of this to create shared wealth creation?
Well, I think that I'm a believer, have been a believer that we have to embrace technology. We cannot run away from it. And AI is real, right? From an India point of view, it is hugely advantageous. If we think about 200 million children in our schools, and if we now think about connectivity to all our schools, and we give ourselves a goal that in 1 decade, right, with a fraction of the total GDP that others spend on education, we can deliver to each of these 200 million kids. And we shouldn't get scared of AI. It's exactly like when the Industrial Revolution came, right? Humanity moved forward. Productivity moved forward. We moved from 0.3% growth for many, many decades or many centuries to 3% growth overall, right? And at that time, if you go back 200 years and if you ask people that can people travel 2,000 kilometers a day, right? We would say not possible. Today, all of us, not two, with flying, we can travel 30,000 kilometers a day. And I think we're just at the beginning of that age. We must embrace it. India has the opportunity, and what we see, as you said, is we see that young Indians, as Kamath Saab said, old Indians, right? India just adapts to technology faster than everybody. We've seen it firsthand over the last 5 years in terms of what we want, and we should use that at our competitive advantage.
We will slip into a very short break. We'll keep getting you snippets of this exclusive and interesting conversation. Before now break, on the other side, Manisha Gupta joins in with a focus on commodities. Stay tuned. Welcome back. As promised, let's talk commodities. Manisha is now joining in with what's got her attention this morning. Manisha.
Well, thank you so much for that. I'm looking at crypto as a market right now because that really seems to be buzzing as well. There's a lot of sell-off that we've seen in the crypto markets in this year till time. Well, last year as well, we did see slippages coming in the last quarter of 2025. 26 has started on a weaker note as well. So 72,000 and below is what Bitcoin is trading at this point in time, which is the lowest level in last 15 months. The last time you saw these levels were November 2024. It's 40% down from its all-time high of 126,000, which we saw being hit in October 2nd, 2025 therein. Well, the declines also have led in various other altcoins as well, all of that trading in the negative for 2026. Positions worth $2.1 billion is what we have seen getting liquidated in matter of last few days when it just comes to Bitcoin as well. Overall, crypto market has seen a wiping of $500 billion in the matter of last 6 sessions itself. So as I said, it's not just about Bitcoin, it's about altcoins, meme coins, stable coins, gold-backed coins, all of that he's seen a very, very sharp decline. The overall market cap when it comes to crypto also has declined quite sharply, currently at around 2.4 trillion. At its peak in 2025, it was at 4.4 trillion. So almost half of what we were at just about 8 to 12 months back there. The sell-off in technology stocks, AI stocks is something that seems to be bothering crypto. And we've seen that risk aversion continue or seep into in this space as well. Well, overall, when you look at the kind of outflows that we've seen from institutions, from ETFs, has been quite on the higher side as well. For the month of January, the ETF outflow alone stands at around $3 billion. And this is in succession of $2 billion of an outflow that we saw in the month of December. November was a huge $7 billion of an outflow as well. So net outflows also is yet another reason that you have seen the cryptocurrency prices continue to decline. So when you look at the market prices this year till time, you have Bitcoin trading 18% in the negative. Ethereum is down 29%. Binance has declined by 19% as well. And that perhaps is just about continues because when you look at Cardano, Solana, Ripple, all of that is down anywhere between 15 to 30% down. Markets do believe that some sell-off could continue in the very near term. It is about government partial shutdown in the US markets, weak US data, some data not available as well, and then the kind of geopolitical tensions that you seem to be looking at, all of that weighing onto this sector as well.
Okay, all right, Manisha, thank you very much for that. Cryptos, of course, taking a very, very large knock as well. We'll take a quick commercial break here. It's our special segment, is the economy. Lata in conversation with GTRI's Ajay Srivastava and former HPCL CMD, Mr. M.K. Surana, on the India-US trade deal and, of course, on India's imports of energy. Stay tuned.
Welcome to It's the Economy. Until now, we have concentrated on the exports side of the US-India trade deal. Now we get to of course, we've gotten to exports at 18% tariff. But what about the import obligation? India has to import $500 billion of goods and services from the US in 5 years, or $100 billion of goods and services in a year. Now, last year, India imported 45 billion worth of goods from the US. So how do we bridge this gap? Do we buy more oil and gas, defense stuff? Do we have to buy US oil and gas, even if it is expensive, to understand all these issues that this massive import obligation enjoins on us? I have with me Mr. M.K. Surana, former chairman of HPCL, and Ajay Srivastava, founder of GTRI, Global Trade Research Institute. Gentlemen, thank you very much indeed for your time. Mr. Srivastava, India imports a lot of aircraft parts, defense, of course, technology. So this 45 billion of goods, if we add services, is it a very big gap?
If we add the services, the gap increases by $10 to $15 billion only.
Okay. So is your sense that we should be able to reach the 100 billion if we add services, or is the negotiation only for goods?
We are already crossed $100 billion, but we are missing one thing. US is saying you buy from the US. If we interpret this as saying buy from US firms based in US or India or anywhere, then we are crossing so much. So if we forget about exports and imports of goods and services for a moment, then how much we pay to the US firms who are operating in India or otherwise? So Indian students, they pay $25 billion to the US, $15 billion as tuition fee, and $10 billion as living expenses. Then US tech giants, all these Amazons and Googles, they earn about $15 to $20 billion revenue from India. Then US banks and consulting firms like BCG or Citibank, they earn about $10 to $15 billion from India. Then the GCCs, nobody talks about them. They earn so much, but they show just 1% valuation in India. They do 100% work in India, but they show only 1% valuation in India, and they shift 99% of the profit as happening in US. So if we count all these things plus defense purchases, I think already we are paying more than $120 to $130 billion to the US. So we are in overall deficit in dollar terms from US, not the surplus as is commonly believed.
That is not the impression I got when I spoke to a lot of market participants. Their fear is that US may interpret it only as goods and may not include, certainly not students paying money over there, or the other things. Maybe technological services will be included. But Mr. Surana, one of the big things that people are hoping will be used to bridge the, import over 45 billion is oil and gas. Will that be something we can increase substantially, considering that, we have just had an understanding with Venezuela as well?
So when we talk of oil, we just talk of crude oil. So I think that we should talk of the total crude and petroleum products and gas as well.
Okay.
So one of the important items which can be seen is LNG, because so far the LNG was not coming to substantial extent from US because they had also some limitation on the export facilities, which are all maturing, and LNG terminals, liquefaction terminals are coming up and all that. And India imports almost 50% of LNG. So in a year, almost $13 to $14 billion of LNG is being imported in India. So that is one definitely a potential source. The second is LPG. So another source can be LPG, because LPG is one petroleum product which India imports. While we are more or less self-sufficient on MS and HSD, LPG we had been importing. Also, there is a plan to increase the use of natural gas in CGD and PNGs from 6% to 15%. So LNG requirement may increase over a period of time. One more important item is ethane, because most of the ethane which is being procured is origination from US. Now, many of the petrochemical plants which are coming, they can be the mixed feed plants where the ethane can be used as a input material for converting into polyethylene or that type of products, ethylene and polyethylene products.
Okay.
So I think those are some of the areas which can be looked into apart from the crude oil. Now, if we come to Venezuela, now Venezuela oil we had been getting earlier, but the quantity is limited and not all the refineries can process Venezuelan oil. So that part we need to keep in mind, and it normally goes as a mix with other oils.
Oh, okay. Okay.
So this is the context in which we can see if at all there is a need to bridge the gap, and these are the potential sources.
Okay. Mr. Srivastava, your thoughts. Will crude oil and ethane, gas, all this account for goods in case US interpreted imports as only goods coming from the US?
US will never be able to supply, even including Venezuela, the oil needs of India, Europe, or South Korea. It's not only India from which US has taken this commitment. This committed energy buys from US or their partners is a part of the EU deal. EU has committed that it will be buying in next 3 years $250 billion worth of energy, which is mostly oil, LNG, etc. only. Same with South Korea, same with UK, same with Japan. US doesn't have so much spare oil, and Venezuela, we know their wells, they produce less than 1 million barrels per day. And they are not in position to supply so much of the demand. So I think hard calculations not being done, or US may have some other plans to get more oil, say by invading Iran or Iraq. I don't know. But right now, if we do the maths, US, Venezuela together, they will never be able to supply the oil needs for EU, South Korea, India, etc.
Okay, so they have overcommitted, they have taken overcommitments from their export partners, and they will not be in a position to supply so much. Mr. Surana, what may be the price differential? If India indeed, I mean, at least incrementally on the margin, we have to shift from other sources to buying all the energy products that you said, petroleum products, crude oil, ethane, gas. Will they be more expensive? I heard a lot of economists pushing up their current account deficit estimates because they are pushing up import costs. Are they costlier from the US?
I think there's one point which is missing is that the refiners who are buying is not like the government budgeted money which we are spending. So the companies have to take their economic and commercial costs.
Oh, okay.
So same way, the supplier from US are not government-owned entities as well.
Okay.
So the question is, there is a private supplier, even though companies may be PSUs or the private entities, but they have to operate in a regime which is a pure commercial thinking. So we cannot just say that if it is a higher cost, we will buy. So it is a commercial decision which will be a competitive thing. So if US oil and gas has to find place in India, they have to compete with the other available supply sources. So one of the item is the freight cost. And to that extent, they have to meet the competitive arrangement which we may have.
Okay.
Now, one thing is because earlier the oil was not surplus. Now US is producing a lot of oil. If they do not export, the local cost of local price will be lower. And their realization will be lower. So there may be incentive for the supplier from US to ship it out, even if it is to give an advantage of freight, so that realization may be there. And that is one of the reasons why WTI and Brent arbitrage remains. And therefore, I would see that ultimately the competitive process may make the US oil competitive in certain situation, depending on the type of the crude and the refinery which is producing.
Okay.
And that may be one way to look at it rather than purely looking as a government-to-government supply. Oil is not a government-to-government.
No, it isn't. Actually, from the US side as well, almost everything is private sector. So
Yes.
exactly how you're, zeroing in on the same problem that Mr. Srivastava was also referring to, that, people to people, there is a lot of money that is going, and clearly India is spending much more in dollar terms. But what exactly will be the contours which are drawn by the trade agreement, we do not know what will be included. Mr. Srivastava, final question to you. Is there in trade agreements, I mean, in your previous avatar, you must have gone through this. Is there something like best endeavor? I heard this from some other ambassadors from other countries saying that we made the best endeavor to buy from you. But as Mr. Surana or you have been saying, they don't have that much oil or they don't have that much gas. Then what do we do? Are there such clauses usually in trade agreements?
We use such clauses amply, but we have to see the legal text what we have used with the US. For Europe, for example, I'll give you an example. For example, they have very precise clauses on sustainability and environment, European Union. We were not comfortable because they have a different level of development. We cannot commit ourselves to those clauses. So we said, okay, let this be best endeavor clause. But even best endeavor is not free from all the fallacies. If they want to stop imports from our side, even though we have used best endeavor, they can stop it because India is saying best endeavor, and whether you are applying best endeavor or not. So even best endeavor is not free from all the fallacies and the problems.
Okay. Point taken. Mr. Surana, just a final question for you, since this is very stock market related. Will there be pressure from the Indian government to especially the state-owned, oil companies, that because of the overall commitment, you will have to, keep US oil or US sources as the first priority when you are buying? Can such things happen and therefore impact the margins of these companies?
See, the way the crude oil is bought, number one is nobody keep all eggs in one basket. So there will always be a diversified source, and there some compromise does take place on the pricing also to ensure that our basket is widely held. That's number one. Now here, there is no doubt that the techno-commercial factors have to be considered when you select the oil. Now, the multiple iteration which we do for linear programming or our crude optimization, and that certain constraints can be put either if there is a supply constraint or if there is some other element. But I will still say that the companies will be required to justify that decision if they are doing it.
Okay.
And therefore, I would assume that ultimately it will be a commercial decision. Maybe contour of a strategy may be there.
Okay, fair enough, fair enough. Thank you very much, gentlemen, for adding so much color and nuance to our understanding. But clearly, we are still left with more questions than answers. Will services be included? Will defense imports be included? Will there be a best endeavor clause? All those questions we will know only when the details of the US India trade agreement are out. And finally, there is always the possibility that President Trump, going by his past record, pulls out some point which he thinks India has not come up to speed, and use it to jeopardize things in the future. All these flashpoints remain in the US-India trade deal as we understand it now. Thank you very much for joining me. That's it on this edition of It's the Economy. After a break, time for Chartbusters.